Netflix stock is down almost 60% year to date. It's been brutal. They've got earnings coming up, and I'm going to tell you if I think the stock is going to continue its crash or if it might be a buying opportunity. First, let's look at their last quarter's earnings and then the upcoming earnings, right? So they announced on 7/19/2022. They beat on adjusted EPS. They beat on GAAP EPS. But they missed on revenue. Okay, there was the big subscriber miss. We know that's what Netflix kind of trades off of. Subscribers and then their forward projection and expectations for subscribers. So upcoming quarter, they're announcing on Tuesday, October 18th, post-market. So after the market closes, analysts are expecting adjusted EPS of 217, GAAP EPS of 213, and then 7.84 billion in revenue. Here's their earnings history. You can see it's over like the last 17 quarters, something like that. Green is a beat. Red is a miss, okay? So what we see is, more beats than misses, but a fair amount of misses in on the EPS, and then same deal with the revenue, right? So a mix there of beats and misses, all right? We would like to see companies just beat, 70 to 80%, 90% of the time. That has not been the case with Netflix, which just means there's a lot of unknowns and unpredictability about the business right now, and a lot of times people don't like unknowns. It's important to note, even though the stock is still down 60% year to date, since 2002, this has still been one of the best investments possible. So here it is, long-term investing, right? Yes, price matters, price you buy matters, but long-term investing is where it is at $10,000 in 2002, just left alone, even with this crazy drop, has turned into over $2 million. Now, it was all the way up to 6 million, which would have been amazing. That's a lot more than 2, but still 2 million is a lot more than 10,000, right? On a percentage basis, it's up 20,000%. Now, something else to know about Netflix. This is not the first time it's been down 60%. It has been down 60% at least 2 other times, almost 3 other times, actually, 3 to 4 other times. And it's been down 30%, probably 10 times since 2002. So this is a volatile stock, and that's what you have to expect. What are the expectations going forward in terms of the multiple on the stock, and is it a good investment right now? Well, what we have to look at is things like its PE ratio, its price to sales ratio, what is built into the current value of the stock, and what are investors expecting moving forward. That's what gives us an indication of, is this thing really cheap right now? Might it be an opportunity to consider? Or is it still too expensive? So that's what I'm getting at right here. We are looking on a price to sales basis. So since over about the last 19 years, the sales growth rate has been about 24%, and that has earned it a 4.6 average price to sales ratio. 24 double-digit sales growth, 4.6 average price sales ratio. So we could see it's currently at 3.5, which is lower than its average, but that doesn't necessarily mean it's a buy right now, because look, the average growth rate has been 24, but analysts are expecting 9, 8, and 10% sales growth rate. That's half the sales growth rate of its historical average. So does it deserve half the price sales ratio? It certainly doesn't deserve the same price sales ratio, in my opinion. So, something down near 3.5 is actually pretty realistic, in my opinion. So now what we can do is we can look at analyst estimates, and now we're looking at earnings, price to earnings ratio. We can look at analyst estimates for growth, and then look at what the price of the stock would be at a certain PE ratio, right? So right now, for all of 2022, analysts are expecting minus 11% EPS growth, earnings growth. Then in 2023, back to positive, 7.5%. Then in 2024, a nice bump, 25%. So we can go out to 2024. Remember, we're long-term investors at a price. It's currently at a PE ratio of about 24. If it drops down to 15, you're looking at a minus 18% total return from now until 2024. If it's up at 18, you're looking at minus 1%. If it stays at 24, which I don't think is realistic, if it stays at 24, you're looking at a 31% total return for 13% annualized. You decide what you think is worthwhile, right? That's price to earnings. Let's go to price to sales. So again, analysts are expecting 9% in 2022, 8% in 23, and almost 10% in 24. So we're currently at a price sales ratio of 3.5. If it goes down to 3, you're looking at a 4.7% total rate of return. If it goes to 4.3, you're looking at a 50% total rate of return for 20% annualized. If it stays right around 3.5, which is what it's at now, you get a 20% total return for 8% annualized. Now, I have based this off of analyst expectations. I've built a little 5-year scenario, low, medium, and high. Low is 7% revenue growth, medium is 9% revenue growth, and high is 11%. That's on average over the next 5 years. Profit margin, 13%, 15%, and 19%. It is higher than previously because they are introducing ads and they might get more efficient with scale, right? Free cash flow, also more efficient with, as the company grows and gets more mature, less growth. So, giving them the benefit of the doubt there. But PE ratio, right now it's at 21, but growth, I think, is slowing, right? This business is no longer going to grow as fast as it has historically. So I'm coming in at 15 in the low scenario, 17 in the mid scenario, and 18 in the high. Ignore price free cash flow, and then annualized return, we want at least 10%. I'm gonna hit analyze. It's gonna tell us where we would buy it if we believed in the low, the medium, and the high scenario. And so here you go. The multiple of earnings you would be willing to buy if you believe this low scenario. You'd be willing to buy right now at 158. Current stock price is 250. That's a lot of downside if you believe the low scenario. If you believe the medium scenario, middle, you'd buy at 218, which is still 10, 15% lower than where we're at now. If you believe the high scenario, you would be willing to buy 20, maybe 25% higher than we are today. So you make your decision, you do your own research, talk to your own advisors, whatever. I'm not a financial advisor. Just sharing my buy price for Netflix. I'm not going to buy the stock. I would consider it under 200, maybe, but there's just a lot of other options out there. And every time we invest in something, we can't invest in something else with that money. So I am not interested in owning Netflix right here. Let me know if you are in the comments.